All right, good afternoon, and welcome to the fourth campus conversation of the year. As you can see from the empty red seat there, we're still awaiting our moderator, but we are a nimble group, and we're going to just get started here. So as many of you know, the goal of the Campus Conversation series is to have faculty, students, and staff engage with each other about some of the big issues of our time, going on now, and affecting all of us. As a community dedicated to social justice and diversity, we come together to try to understand current events and talk about the issues. And let me say, I appreciate you all being here. I know that you had to get cold and probably wet to get over here, so thank you for coming. Okay, you guys are mic'd. You're mic'd.
Oh, we are mic'd?
Okay. Today, the topic is, what is the Tax Reform Act and why does it matter? Now, that may not seem, at first blush, to be directly related to social justice and diversity, but of course it is, because it's about money, from whom it is collected, and how it is spent. And that's very much a social justice issue. We're privileged to have with us today a distinguished panel of faculty from UIC and also from the John Marshall Law School to discuss this topic. We're going to begin, well, we were going to begin with David Merriman. We will begin with him when he gets here, and I'll give his introduction. In lieu of that, we're going to begin with Robert Chirinko, and I'll say a few things about him. He's a professor in the College of Business here at UIC. He got his PhD from Northwestern, and his research examines business behavior with a focus on financial markets, capital formation, corporate governance and finance, macroeconomics, and tax policy. And as you might imagine, there's a whole lot more to read about him. I did not digest it because I didn't think I was introducing him, so we will let it go there. He will be joined after he provides some background, which are actually not his slides, by Professor Erik Hembre and Dean Michael Pagano and John Marshall Law School Professor Kathleen Kennedy, who we're delighted to have with us today. They're then going to have a panel discussion among themselves for a little while, and after that we will open it up for Q&A from the audience. Hopefully you found a paper on your chair, or if you need one, you can just let us know, where you can write down questions, and we will do those during the Q&A starting around 1 o'clock or a little bit before. Okay, so let me say a few words about David Merriman, since that's what I prepared, and he may very well show up. He's the James Ducal Presidential Professor and has a dual appointment in the College of Urban Planning and Public Affairs, affectionately known as CUPPA, and in the Department of Public Administration in that college, and his joint appointment is with the Institute of Government and Public Affairs, also known as IGPA. His major area of research is state and local public finance, budgeting, and how to connect tax policy to the implementation of public policy. So in lieu of welcoming him, I'm going to welcome Professor Chirinko, who's going to deftly go through Dr. Merriman's slides, and then we'll be off and running. So thank you. Thanks very much, Robert. I think you just go.
Okay. This,
I think it's attached.
It's already there. Great.
There you go.
Okay. Well, it's a great pleasure. I can introduce Dr. Merriman.
Oh, my gosh. Okay. I apologize.
David Merriman is a very active researcher. He was so actively engaged in his research this morning that, in keeping with the research focus, he's a couple minutes late. But thankfully, he's going to come and present his own slides, and I'm quite happy to cede the microphone to him.
Okay. Deepest apologies. I'm really sorry. So we're here to talk about this new tax law that passed at the end of last year. And I'm going to give a little 15-minute introduction, and then I'll introduce our panelists, our distinguished panelists, and I'll pose some questions to the panelists for discussions among themselves. And then we'll open the floor to audience questions and comments. So that's the agenda for today. And so I thought I'd start by telling you a political scientist here, a lawyer, and 3 economists walk into a bar. And in an hour and a half, try to explain a massive 1,000-plus page rewrite of the tax code, which was put together by 536 elected officials, Senate, House, and President, truckloads of lawyers, a smattering of accountants, and a thimbleful of economists. It's a daunting task. We'll do the best we can. Before I get to talking about the tax law, I want to do a little tax policy 101. This is a university, so first course in tax policy, what do you learn? The most basic thing is tax revenue equals the tax rate times the tax base. So any change in tax policy can be looked at as changes in tax base and changes in tax rates. Academics that look at tax policy are concerned primarily about 2 things. Efficiency, this is especially economists, the extent to which tax policy promotes the most productive use of resources, including labor and capital. And equity, the extent to which the post-tax distribution of resources is fair. And of course I have fair in scare quotes because what's fair to one person might not be fair to another. But those are the issues that we're going to be focusing on. So what happened with tax policy at the end of December 2017? Anyway, well, there's a book. It's 1,000 pages long. That's the law. If you want to read it, you can. I haven't. But instead, I rely on, the fake news source, the New York Times. This is, so I'm going to give you the basics from the New York Times. And unfortunately, I looked to see, post-passage of the law, whether we had a summary. And all I could find was a summary done after the Senate bill was passed, but before the thing was completely finalized. So I think this is all accurate. I can't be 100% sure this is all accurate. So there's there's more than this in the law, but there's 4 basic taxes that we really have to worry about. The personal income tax, that's the big one. What was changed was the tax rate and the tax basis. Both of them were changed substantially. The alternative minimum tax, which is a whole separate tax system, which is complicated, and we'll talk about it just a little bit, and both the basis and the rates in that were changed as well. The corporate income tax, again, business taxes, tax base and tax rate was changed. The alternative minimum tax, which is a separate tax system for businesses, that was eliminated. Okay, so those are the big macro changes that were made in the tax law. I'm going to focus on the personal income tax. Others may want to speak more about some of the other changes. There's some interactions between these systems, which we'll talk about probably just a little bit. Okay, so this compares the current law, and as I said, it's the GOP bill, but it's basically the law that was passed. There's 7 rates in the old law, there's 7 rates in the new law. Sometimes people talk about complexity in the tax law having to do with the number of tax rates. Number of tax rates isn't what causes complexity in the tax law. What causes complexity in the tax law is the base. How do you define the base? What is it that you tax? And there was some changes in the base. Some of them made it simpler. Some of it probably made it more complicated. Okay, the rates generally went down. Here they list the top rate. That went down 2.6%. Rates went down across the board. Top rate starts at quite high incomes. Okay, what are the big changes in the base? Probably the most important change in the base for most people is the standard deduction. About 3/4 of all tax forms file taxes using just the standard deduction. That increased substantially. It almost doubled. Although at the same time, the personal exemption was eliminated. So the standard deduction is what you get if you don't want to itemize. You just get to take a certain amount of income that you don't pay taxes on, depending upon whether you're married or not. The personal exemption is the amount that you get just for existing, and they eliminated that. So the personal exemption, when you calculate the standard deduction and the personal exemption together, there's a little bit, you can have a little bit higher income without paying any taxes. Okay. In addition to that, they changed the child tax credit. So if you have children, you got twice as big a tax credit as you did in the past, although this phases out at high income. They also gave a credit for dependents. So if you have like an adult person that's living with you, your mother or something like that, you can take a credit now, which you couldn't in the past. Again, those phase out at high incomes. A bunch of other changes in the tax base. Probably one of the most important ones was they put a limit on the amount of state and local taxes that you can deduct. So in past years, in this year, in 2017, if you pay income taxes or property taxes, you can deduct that from your income. It's non-taxable. In the new law, they put a limit of $10,000 on that. That's a big deal for some people and not such a big deal for other people. This only, first of all, it only affects itemizers, which is only about a quarter of the population or a quarter of the tax returns filed. But it also only, the $10,000 limit is only going to be a big deal if you live in a place where taxes are relatively high. Everywhere in the Chicago suburbs, taxes are relatively high. For many people in the city of Chicago, taxes are relatively high. So that'll be a deal. Mortgage interest deduction, unless you have a very, very expensive house, that's not going to be a deal. That's not going to be a big deal. Moving expenses aren't a big deal. Medical expenses will be a big deal for some people with relatively low income that have high medical expenses. In the past, you could deduct some of your medical expenses. Now, you still can deduct them, and you can deduct them at it's a little smaller share of your income. Okay. So how do we analyze this new law? So we can talk about efficiency and we can talk about equity. As I said, that's what analysts generally think about. So in terms of efficiency, there's going to be a widespread agreement among economists that lower marginal tax rates do less to discourage work or less to discourage earning of income than higher tax rates. So to the extent that the tax rates fell, which they did for most people, that's going to encourage more economic activity. On the other hand, it also loses revenue. When you lose revenue, if you don't cut spending, you have to get the money from somewhere to pay for the services that you're buying, and we're going to do that by borrowing. When you borrow, you may cause interest rates to rise. If interest rates rise, that can choke off investment. I think we're going to hear more about that a little bit later, and so that can be problematic. So limiting the state and local tax deduction is also kind of a two-edged sword in terms of efficiency. On the one hand, if you give people the tax deduction when they pay their taxes and essentially buy government services, it seems to them that government services are cheaper than they otherwise would be. So if you don't have to pay a full dollar to get $1 of government services, then you might buy more government services. They might be too cheap, you might buy more of them. So that would be inefficient if people were bought, and that's, I think the reason there was this limit was some people believe that that's the case. On the other hand, government services might have what economists call spillover effects. That is, when I buy education for my child, it not only benefits my child, but it may benefit your child, because my child might be a better worker, or they might be a better voter, et cetera. To the extent that government services have spillover effects, charging $1 for $1 of government services is inefficient. So, you know, those are the kinds of debates that we should be thinking about. What about equity or fairness? Before I talk about what happened with the tax law, I want to give you a little background about equity. So what I did is I went to something called the Statistics of Income, which is what the Internal Revenue Service puts out every year. They put out kind of summaries of what the tax returns show. And one of the things that I think is not nearly widely enough understood is what the distribution of income and tax payments looks like now in general. So there's a whole bunch of numbers, probably too small to read, but if you look at the gray box on the side, you can see the top 6.8% of returns, that's basically incomes over $200,000, have 42.7% of adjusted gross income. Okay, so there aren't that many people with income or tax returns above $200,000. Only 6.8% of them, they pay 43% of, they earn 43% of all income, and they pay almost 60% of all taxes. Okay, so that very top group is paying a lot of taxes, earning a lot of income. The bottom group, the bottom 1/3 of the population, or 1/3 of tax returns, and tax returns aren't exactly the same as income distribution, but the general pattern works. They have only about 6% of all income. So 1/3 of the tax returns have only about 6% of income, and they pay only about 3% of taxes. Okay? So that means that any cross-the-board big tax cut almost inevitably is going to give a big tax cut to people who already have a lot of money, because people who have a lot of money pay a lot of taxes. Okay? And that's indeed what happened. So this is the Brookings Urban Institute analysis of the tax law. And it takes into account not only the changes in rates, the changes in base, but also what happened with the corporate income tax. And what it shows, it breaks down the change in after-tax income as a percent of income for all of the groups along the income distribution. So if you look all the way over to the left, the poorest group, the lowest 20% of people, they got a very small cut in their taxes, or they have a very small boost in their income. That's not too surprising, because they don't pay very much in income taxes to start with, right? As we go up the income distribution, basically there are bigger and bigger cuts. And if you look at the real top group, the 95 to 99%, or the top 1%, they got pretty big percentage cuts. Now, these aren't only dollar values, but these are percentage cuts in their percentage increases in their income, right? And that has to do with the way the tax law was introduced. So, I mean, one question you might have, you can decide whether or not you think this is fair, but we already have a distribution of income that's quite skewed, right? So this doesn't help, at the very least. It doesn't make it less skewed, right? The after-tax income, for sure. The other thing that you notice is there's 3 bars here. So they give you the bars for 2019, the immediate effect, 2025, the little bit longer term, and then 2027. And you can see in 2027 there's a drastic change. The reason for that is to do with the way the law was written. The law was, the Republicans that passed the tax bill had to meet a cap. They could only cut taxes by so much under Senate rules for complicated reasons. In order to meet that cap, they had to have the tax rates go back up again in 2025. So whether this will really happen or not, we don't know, but at least the way it looks now is it's a tax cut for a few years, and if this law stays in effect in 2025, people will see their taxes go back up again, so they won't see that cut in income. So that's my introduction. This is just a summary of the findings. And with that, I think I'll introduce our speakers, and I have to apologize, I have to go down and get my notes on that. And as I said, each speaker is going to speak for about 5 minutes, and we're going to have them speak in alphabetical order of their last names. And so our first speaker is going to be an economist in the College of Business, and this is Bob Chirinko. He received his PhD in economics from Northwestern University up the road, and his research examines business behavior with a focus on financial markets, capital formation, corporate governance, and finance, and tax policy. He's held positions at Cornell, the University of Chicago, Stanford, and a number of other universities. And he's worked notably for the Federal Reserve Bank of Kansas City and also with the Federal Reserve Bank of San Francisco. And his work has been supported by many research organizations, including the National Science Foundation and the Dutch National Bank. And I think notable is he received the Outstanding Doctoral Dissertation Award from the National Tax Association, and he co-won that with a guy you might have heard of called Lawrence Summers, who later was Secretary of the Treasury and, of course, President of Harvard. So anyway, we're very happy to have Bob give us some wisdom on this tax change. Thanks.
Great. Thank you, David, for the remarks, and thanks to you and to Professor Provost Poser to organizing this session. It's a real pleasure to be here. I do thank David for going through some of the details of the tax code, which makes my job much easier. I'm going to go for the big picture kind of issues. Okay. My talk's entitled, as you can see, the recent tax cuts, a coherent economic policy and a seemingly incoherent administration. Okay, and we'll come down to fleshing that out in just a minute. But let me start by asking is the tax cuts that David talked about, is it good policy? Now, policy can be evaluated in many different dimensions. I'm going to focus in my 5 minutes just on one aspect, and that aspect is going to be the size of the economic pie. That is to say, take the all economic activity, divided by the number of people in an economy, and we get our standard of living. And just to give you a sense of that, you can see in the slide, currently, basically the standard of living is $57,000 or so per person in the economy. The question I'm going to ask is, the tax policy that we're talking about that was passed recently, is it going to be increasing, decreasing that pie? Okay. Now I want to introduce two distinct concepts, one of logical coherence, and the second, descriptive accuracy. And let me not worry about details at the moment. You'll see what I mean as I go through this, okay? So let me talk about taxes. And taxes basically distort. That makes a strong statement that no serious economist would disagree with this statement in isolation. So whenever we put taxes on certain things, like cigarettes, for example, it changes people's behavior. You put it on soda, it's intended to change people's behavior, and you put it on the income taxes that David spent more time talking about, it's going to basically change behavior. It distorts, okay? Generally speaking, there are exceptions, but generally speaking, distortions shrink the economic pie, and so therefore the logic is easy to see. You remove distortions, you're going to increase the size of the economic pie. Okay. To get into those details, we'd have to get into issues of efficiency that were alluded to earlier. Don't have time to do that. Please take that as given. Okay. Now, there's two sets of tax cuts we can talk about, one for households, one for businesses. For households, basically, we're reducing personal income tax rates. We reduce distortions. We stimulate economic activity. And three of the chains of causation are on the overhead. One is that the reward to work rises. People will work more. The reward to saving, putting your money in the bank or the bond market, not stock market necessarily, but the bond market, and basically you'll get a higher return, you'll do more of it, and your net of tax pay rises, therefore you feel richer, you'll consume more. Okay? The economic pie is going to basically increase as a result of these tax cuts to households. There's tax cuts to businesses as well, reducing again the income tax rates, and there was that distinction between tax rates and tax base. I'm focusing on tax rates here. Again, distortions are reduced. Economic activity is stimulated. From a business's point of view, there's a reward to investment is now higher. Investment's going to rise. Workers are going to become more productive with higher wages. Okay? Firms are now able to compete internationally much better than before. There's going to be more jobs. So can this really be that simple? Reduce distortions, cut taxes, we're all better off. Any of you who've taken a course in economics or finance know that we have to have an equation. My equation is on the board here. Spending minus taxes is equal to the deficit. Something has to give if you give tax cuts, okay? Either spending must decrease, the deficit, which would be a problem, because the government has a number of things it needs to do, supporting education, research, infrastructure, and so on. Deficits might have to increase. Therefore, there'll be less funds available for borrowing for things like student loans. or perhaps the taxes will increase and there'll be more economic activity, okay? So the key assumption here is that the response to tax cuts will be very large. Those arrows I had in the previous slides for households and businesses is going to be very, very large. So large that the tax cuts will pay for themselves. There'll be no need to decrease spending and no need to do the deficit. Let me skip the caveat. And so the point is this policy logically coherent? And the answer is absolutely yes, for the reasons that I mentioned. And again, let me slip over that slide a little bit quickly. Perhaps these could be posted at some convenient spot. Okay. The important question, that was the second key concept I wanted to introduce, which is about descriptive accuracy. And in blue here, how large are those responses? Are they sufficiently great to pay for themselves? Academic opinion split, and basically there's lots of statistical analyses. Let me consider two situations. Okay, you have a decrease in tax rates. Greater reward to working, more hours worked. I'll go out there and want to spend more time taking someone some extra assignments. But if you have a decrease in tax rates, my income's higher. Okay, if the goal was to reach a certain level of income, I may decide I want to work less. Okay, so basically there's two conflicting effects here. The net effect is ambiguous, and those of you who've taken economics know that I'm talking about substitution and income effects. Response by business is also somewhat, but I'm getting pressed by our chair here, but there's a similar sort of trade-off there. In summary, the tax policy is logically coherent for the reasons that I sketch out. It's descriptively accurate. I believe no. I'm a guy who believes that the responses are relatively small and that government spending will have to fall or deficits will have to rise. The implication, lower standard of living. Okay, last point, you're asking, has this guy basically been watching the stock market since Trump was elected? This has gone up 30%. So this guy's telling me the pie is smaller and the stock market's up 30%. Keep in mind, I only focused on one aspect of the policy. Stock markets related to different aspects and issues in particular of distribution and inequality that perhaps we'll get to later in the Q&A session. Thank you. Okay, I'm sorry.
No, that's okay. Okay, so our next speaker is going to be the third, the trio of economists, and it's Erik Hembre, who's an assistant professor in the Department of Economics. And Erik received his PhD in economics from the University of Wisconsin in 2014. That's also my alma mater, so I'm very happy to have him here. His research is primarily focused on public policy and housing-related issues. And in one recent study, he examined the impact of first-time home buyers' credit on home ownership rates. In other studies, he studies the impact of differences in state income tax rates on professional sports teams' performance, and that was cited by several media outlets, including the New York Times and the Washington Post. He has worked on issues of mortgage defaults and foreclosure. Prior to receiving his PhD, he worked at the Federal Reserve Bank Board of Governors in Washington, D.C. So, Erik, thank you.
All right, well, thank you for having me here. I'm really excited to discuss the Tax Cut and Jobs Act a little bit with you guys. There's a lot of stuff that happened in this tax policy, some of it good, some of it bad. I'd like to focus my comments on two elements that I think are generally good. And so the first one is going to be related to issues of equity, and the other is going to be related to the mortgage interest deduction, and they're going to be somewhat related. And so as Professor Merriman was talking about, one really important aspect of the tax policy change is how we view changes in tax rates across the income distribution. So people making higher incomes relative to people making lower incomes, how do their taxes change? And as economists, we might call that how it affects vertical equity across the income distribution. And I'd like to talk a little bit about horizontal equity, which is looking at people making similar incomes but have variance in how much they pay in income tax rates. And that's another issue of fairness that you might be interested in. And so in general, you might think that a good policy is that people who earn similar incomes should pay similar amounts of income tax. And I think that that's at least an area where this tax cut improves equity a little bit. And so the biggest reason that you have this within income level variation in tax rates comes from tax deductions that people take. So things like deductions from the mortgage interest deduction, state and local taxes, charitable contributions. These are all deductions that people take that lower their taxable income and make it so that they pay less income taxes. And the big way that the tax bill influences this within income tax difference is by raising the standard deduction, almost doubling it. And so this is going to matter because in order to get a benefit from the mortgage interest deduction or other deductions, you have to itemize. And to itemize, you have to have a certain level of overall deductions. And so like once you're above $12,000 in deductions, you're going to itemize. Before that was above $6,000, you're going to itemize. And for people who claim the standard deduction, you're essentially paying the same tax rate. There's still other adjustments, but that's a big way that you get variance in tax rates. And so prior to the tax cut, about a quarter of households were itemizing their deductions, and afterwards we expect about 10% of households to itemize their deductions. And so that's a really big change. It's almost a 60% drop in the fraction of households that are going to be itemizing their deductions. And on average, when you itemize your deductions, the average benefit to a household is about $4,000. So it really can create some differential tax rates even within similarly income households. And as students here, most likely residents in Illinois, you might be interested to know that on average, Illinois has a somewhat lower itemization rate, even conditional on income in the US. So it ranks about 35th out of the 50 states in terms of the fraction of people who itemize. So if you were comparing a household in Illinois relative to a higher itemization rate state like California or Massachusetts, if you had two households who were making similar incomes beforehand, someone in California or Massachusetts would be paying lower federal income taxes, and afterwards that's going to be less often the case, or the taxes between those households will be similar. And so I think that that's an interesting aspect. So that my other comment is going to be related to the mortgage interest deduction, which accounts for about 20% of all deductions that are taken on average. It's pretty difficult to find a policy in which there's more agreement among economists that they dislike it. It's kind of, at best, it's a poorly designed policy, and at worst, it's counterproductive to the goals that it tries to achieve. And what the Tax Cut and Jobs Act does is it really kind of takes the legs out of the mortgage interest deduction, partially by lowering the maximum amount of mortgage interest that you can deduct, but mostly through this fact that a lot fewer people are going to be itemizing their deduction, and as a result getting a benefit from the mortgage interest deduction. So right now we're paying between $80 to $90 billion a year to subsidize mortgage interest. That's a pretty substantial number. Afterwards we're going to expect that to be more like 20 to 25 billion. So that's a pretty significant drop in the value of the mortgage interest deduction. That's going to be good for all of you who right now are renters and looking to be homeowners in the future. You know, approximate guesses are going to say that's going to lower home values by roughly 9 to 12% over time, not immediately, but over time. And so that's good for renters. Even for people who own a home right now, if you're not in the biggest home you're ever going to live in, that'll be good, because next time you move, the house will be a little bit cheaper. It's also going to actually expect to raise home ownership rates by roughly 2 to 3%. So even though you're taking away a benefit that goes to homeowners, it will likely end up having a small increase in the home ownership rate, which I view as good. And then even kind of more broadly, the fact that it should reduce overall mortgage debt, or the percent of people that have mortgages, could add some stability to housing markets and just make the likelihood of a housing bust or foreclosures in general to decrease. So anyway, that's all. Thank you.
Thank you. Okay, you're finally done with the economists. So the next speaker is going to be Kathleen Kennedy, and she holds an undergraduate degree from Drake University and a JD from Northwestern University, so we're a benefit of gains from trade with Northwestern. After law school, she practiced with the law firm of McDermott, Will, and Emery in Chicago, and was an actuary with an actuarial consulting firm of Towers Perrin. After years of private practice, she joined the John Marshall Law School as a full-time faculty member. And she led John Marshall's efforts to offer the LLM in employee benefits, which is the only one of its kind in the nation. and she's chaired John Marshall Center for Tax Law and Employee Benefits since 2001. And she was recognized in 2009 as ASPA's Educator of the Year and recently inducted as a Fellow of the American College of Employee Benefits Council and now serves on its Board of Governors. She's published many articles and is a frequent speaker at professional events. And with that, I think I'll turn it over to her. Thank you very much.
Thanks very much, David. Thank you very much, Susan, for inviting me. It's a pleasure to be here. I just want to cover two things in my introductory remarks. One is that the TCJA was a very rushed piece of tax legislation, and if we learn anything from history, we'll discover that it'll have unintended consequences because they don't have all the right people in the room at the time. One example of this is in order to find revenue from individual income in order to support a lowering of the corporate tax rates, there is a casualty loss deduction that you and I can take if we have unreimbursed casualty losses due to fire, floods, tornadoes, etc. They modified this deduction such that you qualify for it only if the casualty qualifies for federal disaster relief. That obviously will shrink the number of people that can take advantage of the deduction. But it will also have a domino effect in that things that used to qualify as a hardship distribution under a 401k plan will no longer be allowed. I'm sure nobody in Congress intended that result. And we're discovering other unintended consequences as we pile through this massive piece of legislation. The other thing I want to just briefly discuss is something that was on the chopping block, and that was the Rothification of 401k plans. Let me explain that. I bet almost every American can identify at least one federal tax code section, and that's 401k. So that allows workers to make pre-tax salary contributions into a qualified plan, and they can accumulate tax-free for 20, 25, 30, 40 years. And taking into account the compounding of interest, that can result in a very, very large nest egg. Since none of this money was taxed during the worker's working lifetime, it's all taxable upon distribution as the employee takes that into income. Similarly, if you're working and you don't have a 401k plan, you can contribute into an IRA with pre-tax contributions. The difference between a 401k and an IRA is the maximum amount that you can defer. A 401k allows you to make pre-tax contributions of up to $18,500. In an IRA, the maximum deduction I can get is $5,500. So a big difference whether I have a 401k versus an IRA. Several years ago, Congress extended to IRA owners the ability to make a Roth contribution, and that was named after Congressman Roth out of New York. So the idea here would be I'll make after-tax contributions to the IRA. It'll grow pre-tax until I retire, but then all the money coming out is tax-free, meaning the interest that has accumulated in that tax-free IRA comes out tax-free. So a few years ago, Congress extended that to 401k plans. You can make your 401k contribution an after-tax Roth contribution. Why would I do that as opposed to make it a pre-tax? Because all the interest accumulation coming out is going to be tax-free. That's the advantage of doing it. Well, Congress was considering two alternatives. One was to put a lower dollar cap on the amount of pre-tax 401k contributions in the neighborhood of $10,000 as opposed to $18,500. And another proposal was to make all 401k deferrals after-tax contributions. Now, why were they considering that? Because they'd get a huge flux of income immediately from these after-tax contributions. The problem was there was no guarantee that this pass on all the interest accumulation growing tax-free would continue. Thank goodness, due to the efforts of lobbying, they preserve the pre-tax deferral characteristics of 401k and IRA, but Congress has told us that retirement savings is on their agenda for 2018, so the story may not yet be over. Thank you.
Okay, and our final speaker is Professor and Dean Pagano. Who I know quite well, but I still have a write-up about him. He's the Dean of the College of Urban Planning and Public Affairs at UIC, and he's a professor of public administration. He's a fellow of the National Academy of Public Administration and a former co-editor of the Urban Affairs Review. He's published over 80 articles on urban finance, capital budgeting, federalism, transportation policy, infrastructure, and many other topics, and given many, many speeches and published a number of books on city finances. He earned his BA from Pennsylvania State University and his PhD from the University of Texas at Austin. So I'll turn it over to him.
Thank you, David. Good afternoon. I want to make just a couple of points, and then we're going to be opening this up for conversation, but I want to make this point. What happens in tax reform doesn't affect just what we think of at the federal level. What happens in tax reform is that it affects what happens at the state and local government level as well. I think as the provost said at the beginning, this may not seem to have much to do with social justice, but it has an enormous amount to do with social justice, and that is this. Once you're taxed by the federal government, are you willing to pay another dollar for a housing program, education, or whatever is at the local level? Or do you feel like your taxes are already too high? I'd break into my Alexander Hamilton routine, but I'm a terrible singer. In Federalist 31, remember the Federalist Papers, don't you? In Federalist 31, Alexander Hamilton had to counter the Anti-Federalist comment about what would happen if there were two sovereign, independent organizations. One's called the state, one's called the federal, or they called it the central government at the time. If the central government imposed a tax, would it restrict the ability of the state to impose a tax either on the same good or at least raise your tax burden? And Brutus, the Anti-Federalist, said this would lead to the destruction of the state because the federal government would have the principal connection to the tax structure. Hamilton argued the opposite. He said that because states are sovereign, they should not worry. Citizens are more closely connected to their states because states are involved in protecting life and property, and the federal government is less so. And concludes that, quote, there's a greater probability of encroachments by the states upon the federal head than by the federal head upon the members. Regardless, there's competition, and in a federal system, we have to recognize that both the states and the federal government have the authority to impose a tax. Erik presented a fascinating figure that I was unaware of, and that is that it's possible that the value of property will, because of the mortgage interest deduction, will reduce the value of property by 9 to 12%. Well, the property tax, real estate, is the primary source of revenue for most municipalities, almost all school districts, and almost all counties. Those are the ones that provide the kinds of services that we expect, which is the protection of life and property. If it declines by 9 to 12%, imagine what that's going to do to your local elected officials in saying, we need to raise your property tax rates. When we already are being told in Illinois, we are among the highest property tax paying states in the country. Are we going to be willing to do that? And if we don't, then what happens? Fewer services, and then we have the social justice question of which services will be reduced. Second problem, there's according to the Congressional Budget Office, a $1.5 trillion shortfall at the federal level alone with this tax reform, $1.46 trillion. How is that addressed? Well, the optimists would say that the economy will grow. Well, if the economy grows at over 4%, which it hasn't ever done, at least in the last 30 years, maybe we can outgrow that $1.46 trillion deficit. Otherwise, we're going to have to find things to cut. So, my message to you is be careful what you wish for, because what is most vulnerable are the social service programs and the health programs, Medicare and housing and support for the poor. Those are the ones that are going to be targeted first, and in fact, if you listen to the debate last fall, those are the ones that they had actually talked about. We need to have a reduction in domestic spending. Domestic spending is code for social services. If that's going to happen at the federal level, and at the local level, you're going to have to raise property taxes. We're in for a bitter battle about the survival and soul of state and local governments in the United States.
Is this mic on? Is that on? Yeah, now it's on, right? Okay, so I thought we'd take maybe 10 minutes or so to talk among ourselves on the panel, to have some comments, and I have some questions for the panel. And then we're taking questions from the audience. I've got some cards already, but if you have questions, you can write them on cards. And so the first question, which is covered in people's talks, but not completely, which is basically, what do you like about this tax policy? What don't you like about the tax policy? And I'll just have you volunteer to whoever wants to go first with that. So, Kathleen, I hear you nod.
Sure. You may not know, but there's a new family leave tax credit in this law that I think is very favorable. It's in response to many states that are mandating paid leave for certain medical reasons, family reasons. The bad news is it's only good for 2 years. That's all it could store for. So I think it's a positive step. The bad news I think, was the elimination of the Individual Affordable Care Act mandate. I think that's going to, starting in 2019, disrupt the insurance markets and have ripple effects for employer-provided plans. So those are my quick response.
Okay, mine would be to dovetail to some of the previous comments, would be the simplification that would occur for a large number of the households. Going through the tax code preparation of one tax returns really is horrendously complicated, and the simpler that becomes, the better it is. The big negative is also talking about some of the data that had been up, is the inequities that are occurred. You may remember the bar chart, I think, that Dave had up, and you saw the large percentage changes for people in the higher income groups. And this tax code changes really favors the upper income groups in a really extensive sort of way. So if you thought of inequality as a problem going into this, it's going to be even more of a problem going out. And we haven't talked about things like estate taxes and other things which also favor the very well off.
Erik?
Yeah, so I mean, I'll reiterate my favorite part of the tax code is that it really makes the mortgage interest deduction a lot less valuable. And I mean, the hope, I think, is that with so many fewer people claiming it over time, it'll erode support, and we'll be able to get rid of it completely. And I guess things that I don't like it would be kind of reiterating what Professor Chirinko said, in that I'm really skeptical of the impact on the deficits, and I really think that it's somewhat reckless to not make it a little more balanced budget without having some rosy expectations about the future.
I think that it has particularly had an effect on the taxpayers in about 6 or 7 states that are most affected, considered to be the high state and local tax states. Illinois is one of them. And what that does is it's now going to expose the costs of state and local services within the state of Illinois, and I think it'll push the question about whether we're paying too much, and I think we know what the answer is going to be to that.
Okay. So the next question I have, I actually wrote for myself because I wanted to hear what the rest of the panel had to say about it, but we'll also get their questions. So the question is, what's the least what aspect of the tax change do you think is least well understood? And I mean that in 2 senses. In one sense, does the general public understand that? And the other sense is, do experts understand what it means? And to me, something that I find very hard to get my mind around is, it's a little bit technical, but it was meant to help small businesses, and what it is there is a different rate for pass-through income of small businesses than there is on earned income. So if you are a small business owner, say a plumber, and you make some income, your tax rate on that will be lower than if you were an employee of the plumbing firm and you paid income on that. And what we don't know, and what economists worry about a lot is, well, shouldn't you change your form of business, right? I used to be an employee, now I want to own the business. And this could happen in a lot of different ways. A lot of people who previously were employees might become some kind of owners that have lower rates. And so that's something I think we don't really understand the implications of that or what that's going to do in terms of the economy. And so I'll let other people, maybe somebody else can explain that to me or has a better idea or have other things that they think are not so well understood.
So you're suggesting I should contract my teaching services out to the university?
Right. We want the provost to start thinking
great.
about
Well,
that.
we'll look into that. Thank you. I appreciate it.
That might come to our disadvantage. Now, a point that I would like to make is that I don't think we know what the prices are for local government services, and having a conversation about national tax reform does not allow us to understand what's happening at the local level. So I worry about the fact that city governments in particular have not yet rebounded from the Great Recession. We have a disconnect between the tax system we have and the economy. You saw the economy blasted through on the stock market over the last couple of months, and we sort of sense that, well, therefore, other governments must be doing okay. The federal government is, because the federal government is tied to income defined very broadly, including capital gains. Local governments are not. State governments are to a certain extent, but they're not as dependent as the federal government. And municipal governments are not. So and school districts are not. And they're the ones that are providing the on-the-ground services to the cities and the citizens. And the question is that if there is going to be even more pressure at that level, because they haven't even rebounded to where they were in 2006, 2007, they haven't rebounded. And now we're getting, that's news to me, Eric, that property values may decline over the next decade or so. And we have a $1.6 trillion deficit on top of it. It's going to come home to roost at the local level, and we have not had that. We haven't had a conversation about the effects on state and local governments in particular.
Erik?
Yeah, so similar. So I'm also really interested to see how this impacts state and local governments. But I guess something that I feel that I've at least heard in the media or seems somewhat misunderstood to me or is surprising is I think that the cap on state and local governments combined with property taxes would actually be a proposal I would have expected Democrats to have in the bill if it weren't for the case that blue states have higher state and local taxes, because it's a very progressive move in the tax base, because not only do you have to itemize, which skews towards higher income, but you have to have more than $10,000 in income and property taxes. So it really affects high income earners. And so I guess I've been surprised that there's been so much backlash, especially against Democrats on that position, just because it does go towards one of the issues that they care about as well.
If I can, so I agree. It is more progressive because you're having the higher income states paying a greater share of their tax burden than they were in the past. There's a flip side of that, and that's the transfer of resources to Washington. And all of those states that you've mentioned are donor states to Washington. They're not the recipient states. They're giving more in taxes, federal taxes, to Washington than they're receiving from Washington in services. So if there was a balance on that side, states like Illinois might get more back. But right now, we're a donor state to the national, to the rest of the other 49 states and the federal government.
And the other point, Erik, that I've had made in conversation with me is that it's true that on the tax side of it is progressive to the extent that it undercuts expenditures, which many of which are redistributional, school equalization, for example. You know, it may not be a progressive policy to cap state and local policy taxes. Yeah.
To the question about least understood, and I think it's partly related to some of these discussions, is this thing called the alternative minimum tax, which probably a lot of people in the audience haven't confronted yet, but you might have if it hadn't been mostly abolished. It creates lots of very odd relationships between mortgage deductions and all these sort of things that we're talking about, to points where I'm not sure the tax accountants fully understand exactly what those implications will be. again, I'll go back to my initial point. One of the things I liked about the tax code was more itemized, more standard deductions and simple tax forms. This is going to make things even more complicated, and that's a bit unfortunate.
So, go ahead.
Another wrinkle in all of this has been least understood is there's an obscure corporate deduction section 162M that basically says all pay of certain executives in excess of $1 million is non-deductible unless it's performance-based. So for the last 10 years, we've been going through hoops, making all this excess income performance-based with outside metrics, et cetera. Well, instead of just eliminating that, they took out the exception. So all pay in excess of $1 million will no longer be deductible, which is sort of ironic because half of the firms that pay in excess of $1 million don't take the deduction anyhow. So it's not much of a loss in revenue. But they put in an obscure thing saying contracts in existence on November 20th that aren't materially modified after that will be preserved under the old rules. And so now everybody's scratching their heads as to what does that mean. And that'll take a lot of useless hours trying to figure that out.
So I think I'd like to get to audience questions now, because we're getting a bunch of them. And I got two on a similar point, which is, and the question is, how will the tax code change affect donations to higher education and charitable giving in general? So anybody want to comment on that?
Sure. Yeah, go back to Dave's initial comments about tax rates and tax bases. And one of the things that was in the tax code for those people who were going to itemize their deductions, generally speaking, higher income people, would be the donations for charitable undertakings, be it a house of worship, educational charities, or what have you. The value of those deductions depend very much on the tax rate. You lower the tax rate, the value of the deduction has fallen, and therefore, all else being the same, I would not want to give charitable contributions. So there's sort of a double whammy. Again, if you take the standard form, the standard deduction, your charitable contributions will not affect that as well. And so there's a real potential loss there in terms of that activity.
Erik?
Yeah, and just to add on to that, I mean, you would imagine there might be a decline somewhat in charitable contributions to universities because of the more people taking the standard deduction. And I don't know enough about where that pie of charitable deductions come from, but it seems as though that skews pretty highly into the high income with big level donations. And those, for the most part, wouldn't be affected or even could be more incentivized with the rise in the alternative minimum tax threshold level. So it's tough to know on average. There's a reduced incentive for charitable contributions, but it'll be really interesting to see how it changes.
Another question. So why were income tax modifications, and maybe we should turn to our political scientists for this, why were the income tax modifications set to expire in 2025, the personal income tax modifications, while the corporate tax reduction was put in permanently?
I think, Kathleen.
All scoring, all scoring.
It's all what?
Scoring.
It's all scoring, so meaning that the Senate had to get under the targets, right?
That's the way to do it.
I guess I would say from an economist's point of view, I'm not going to say this was the motivation. From an economist's point of view, if you had to make one permanent and one temporary, you'd want to think about, well, who needs the longer planning horizon, right? So you might say, well, if businesses know their tax rates are going to go up, then they might distort their behavior in a certain way. Okay, so maybe they make their profits up front where the tax rates are going to be low, and then they kind of don't worry about the long-term future. Whereas for individuals, you might think, well, maybe they have less ability to move their income around over time. I'm not sure whether that was discussed, but it's the kind of issue I guess I wish had been discussed in sort of setting tax policy.
Well, I think that's the question. What was discussed? There were very little conversation. There was almost, I was talking with Dick Simpson before this, the 1986 Tax Reform Act would never have happened if it wasn't for the fact that Dan Rostenkowski took everybody out to a resort, locked the doors, and kept the media away and said, we're going to come back with the bill, which they did. And it was who knows what, well, we now know, but what the conversation was like behind the closed doors. We don't know what the conversation was like yet behind the closed doors, which was only with the Republican Party. Rostenkowski brought both the GOP and the Democrats together when he went to the resort. So we only have one party who's talking to itself, and we don't know what it said.
And this was extremely rushed for tax
It was
legislation.
done very, very quickly for a number of political reasons. So I think this is an interesting question. Would you consider this tax bill as an overall wealth distribution to the top 1%? And so I have one yes.
Okay, can I amplify on that slightly?
Please.
I think it's important to make the distinction between income, like how much you make in a given year, and what your wealth and assets would be. And we've kind of touched on that a little bit, especially with this housing, the decrease in the housing prices that Erik mentioned. So there's really two things that are going on. One is the tax rates are lower, your income will be taxed less, and as David's slide showed, that really favors the people who are well off. But they also have a lot of assets, like their house, stocks and bonds and so on, and those things change as well. And indeed, the fact that the stock market's gone up 30-some% since Trump election suggests that there's a second aspect to it as well. So I guess the point I'm trying to raise is that when we look at the impact on wealth, on distribution, don't look at just at income tax rates.
Right. You
got to look at the changes in wealth positions as well, and the housing is going to be a really huge one, as well as the stock market.
I would agree, but now just to back off a little bit on the property values, is that's not where wealth is invested anymore. It's not as much in the real estate market as it was in the past, but it's a global market, and so the investments and the returns are coming from other kinds of activities than they were in the past, and that does then skew it more toward the 1%.
I would have Dean Pagano and I have a long history of disagreeing in public, so we'll continue that today. Which is, that's true about wealth overall, but for a lot of households, their biggest asset by far and away is the house they own. So that really gets to be a big hit. The people living on the North Shore who have a very multi-million-dollar house, it's not as percentage-wise as important to them as the person living in other areas with middle incomes and so on.
But a lot of middle incomes, a big part of their assets are also their 401k plan.
That's true.
And so any thought of taxing that differently would be very, very shortcoming.
I guess, just to also respond, I guess I'm a little more unsure of how much of this is going to end up being wealth redistribution just to the 1%. I think it'll take a little time to tell what the behavioral responses to a lot of these deductions are. There's been it's tough to know exactly what the tax implications are. We make good guesses up here, and that's what people do, but depending on assumptions, it could change. There's been other estimates that it's relatively tax neutral by income quartile, but it's tough to know for sure, so I couldn't say for sure yet, especially with like the reduction in the corporate income tax rate, how much of that ends up getting passed on to workers relative to stockholders. It's tough to know for sure. There's plenty of evidence. Most of it will go towards stockholders or maybe CEOs, but I think it's tough to know for sure.
But then the headlines have been, I'm going to increase the match to the 401k. The employer's going to increase the match, or I'm going to give everybody $1,500 in bonus.
Right. So I want to make one point, which is the numbers that I put up show that the income distribution is incredibly skewed in this country. I don't think we should rely on tax policy or think that tax policy is ever going to fix that. I mean, if you look at the changes in the income, yeah, there's changes and maybe more of it goes to the higher income, maybe it doesn't. But the point is, we're starting from a point where we have very skewed income. If we want to fix it, the tools are probably going to be through the labor market, through education, through those kinds of things. It's probably not going to be income tax policy, and certainly not federal income tax policy, that's going to dramatically change the income distribution.
I disagree.
Okay. So you got both sides.
I agree.
Income tax policy made a great impact on reducing income disparities from the 1920s through the 1990s. I think it could do it again. But I'd like to pick up on a point, though, that there are behavioral risks. States are going to adjust somehow. If the states end up losing because the itemizers no longer can take more than $10,000, if states are going to be affected by this, there may be a push by those who have more than $10,000 in state and local taxes to make their states do something different. And so two behavioral changes that are being considered now are pretty clever, and I think one probably will never pass muster. What if the state of California has proposed this, created a 501c3, and the 501c3 is effectively so
A nonprofit.
It's a nonprofit corporation, so rather than anything above $10,000 that you owe in taxes, you now give to them, so you keep your property tax bill and your income tax bill low, but you give this 501c3, the other $20,000, you can deduct that because it's a charitable contribution. And then that money turns around and pays for government services that would have been paid from your taxes anyway. I've seen the lawyers talk about this one. This will tie anybody in knots. But the second is a transition from most states, 44 I believe, have a state income tax. If those states, especially the high income taxes, shift from income to a payroll tax, the payroll tax is deductible to the employer. That's only provided by the employer. But it means it protects what you as an employee might make only if you agree to reduce your salary by the amount that your employer is now paying. So think of the politics of that, or the union bargaining of that. I'll take a 4.5% reduction, Illinois, I'll take a 4.95% reduction in my salary if the university will pay, in its payroll tax, will pay the equivalent of that to the state. It lowers my tax liability, so I fall under the 10,000. I'm fine. The state ends up getting what they were going to get anyway. We continue to have services the way we've had before. That one probably has, it doesn't have the political, it doesn't have the constitutional or legal problem. It has the political will and the way we as laborers and we sell our services will view am I taking a pay cut? And the answer is no, you're not, but it sure looks like it. Right? Anyhow, I think the behavioral responses, as you said, will vary across the country. How state and local governments react to these will be, it'll be a great experience. Keep us busy for a long time.
Yes, exactly.
Wow.
To go back to, so I've disagreed with the dean, I disagree with the moderator now. How did the Nordic countries create such income flat distributions? And it's through taxation. I mean, they have good educational systems, but that's only part of it. And I would also just point out, if you train a lot of people in a certain area, you increase the supply of them, you're going to tend to push the wages down for that particular group as well. So I do think tax policy is the thing that we need to use if we want to basically address income inequality issues.
Okay. So this is a question for Ms. Kennedy specifically, but I think other people might want to speak as well. So the question is, what would you suggest to do to avoid the pending assault on our retirement savings? Is there anything outside of voicing our outrage to Congress and to representatives that can be done to do
Yes,
this?
there are very active lobbying organizations, ASPA, Erik, that are really advocating on behalf of employers and employees.
Thank you.
It's now the prime savings vehicle for the average worker. And so to the extent it's reduced or the interest on it is altered, we're all going to be hurting. And we all know that Social Security, may not be the safety net that we thought it would be, given the funding of it.
I will say that public finance economists have spent a lot of time looking at the distribution of retirement savings across the individuals and households. And, if you think that there's skewed distribution of income, there's even more skewed distribution of retirement savings. And that it's very, very high up the income ladder that people have essentially no retirement savings. And so, and with the baby boom, starting to retire, it's a very, very frightening thing, I think, in terms of what we're going to do in our future. So it's hard for me to believe that any kind of enlightened public policy would do anything to discourage retirement savings. Now, you might want to, I think you might want to change the retirement, you might want to encourage more retirement savings, especially among lower income individuals. But to discourage them seems, so I guess my answer is we should distribute more widely these very, very basic analyses of what the distribution of retirement savings is.
And don't forget with the defined contribution, a 401k is a defined contribution plan, which means all the investment risk and the mortality risk is on the participant. Will I outlive this lump sum? Yes, I could outlive it. What if it's not sufficient? What if I go until age 100 and it's no longer sufficient? That risk is all on the employee. That's why the employer set that plan up. It no longer wants a defined benefit plan where it assumes those risks.
So another question is, would it have been feasible for businesses to stay in the U.S. if we would have continued taxing our businesses at 36%? That was the old corporate rate. While the average corporate rate is 21% around the world, and the average in Europe is 19%. So how much do those corporate rates matter? I'll turn to Bob since.
It's a business question. I hate to say it this way, but it's kind of complicated because it's not only the tax rates, but the way in which we tax the companies. And there's two broad things. One is called a territorial system, and the other is worldwide. The U.S. tends to use worldwide, so regardless where the income is made, it would in principle be taxed here. Many other developed countries use a territorial system where the company's located is where it pays its taxes. And so there's sort of two different things going on there. One is these rates, which have gotten a lot of attention, but also the nature of the system. And the nature of the system was not changed, I believe, very much in this reform, but could be sometime in the future. To go back to the direct question, the companies seem to be doing very well. Apple seems to be doing real well. And the argument is that they have all these funds overseas just waiting to come back. I wouldn't be too concerned about that because when the funds have come back, there have been some tax holidays. So businesses do bring those funds back. They don't increase investment or so on. They basically increase dividends and payouts to shareholders. So it's not going to have, I think, a major impact on business decisions. It keeps accountants busy. And accountants are, since there are some in the audience, let me say they're very fine people. And it's good to keep them busy with very sophisticated tax strategies. And that certainly is a way in which it sort of mitigates any negative competitive disadvantages.
Any other comments? Okay. If there was a change in the political leadership in the House and or Senate, can major elements of the tax policy be changed? Or I guess I might ask you to speculate a little more broadly. You know, what happens in 2025? What do you think about long-term tax policy based on this change?
I would just say historically we had a big one in '86. We had a big one in 2016. It seems to take 30 years to get these things to happen. So I think they're very infrequent, I guess, just given the historical record.
I agree. I don't think we're going to see, there may be some tinkering around the edges, but I don't think you're going to see massive tax reform again. If there were a change, it would have to be a complete revolt in both the congressional and in the presidential leadership, because that's the only way this got through, but one party controlled both branches. I don't think we're going to see massive tax reform. We'll see tinkering at the edges, but I don't think we're going to see. The other thing is let's assume that both the Senate and the House flip next year. The president doesn't flip. The president vetoes everything. We learned that lesson from Obama. He vetoed his last 2 years out.
Well, let me just break it apart a little bit. I mean, I think you're probably right about the personal income tax. In particular, I think the higher standard deduction and having less itemizers is probably something it's going to be very unlikely to change back, which is a real fundamental change in the system for a lot of people. But on the corporate tax, business taxation, I think there might be, in my view at least, it's a little more obscure and there's more possibility of it changing, maybe not rates going up, but certainly what's in the base.
But I think it'll be just tinkering around the edges.
No.
Well, what's interesting is on the tax reform is that in 1986, President Reagan was the president, and he's the guy who actually started those policies. Took a couple years. But Republicans were in charge of the Senate, Packard, right? And then Rostenkowski, a Democrat, was in charge of the House. So it was an interesting thing with bipartisanship that probably would be less likely to occur today or anytime in the foreseeable future.
Okay. So this is something we've talked a little bit about, but just a question on how the threats of state local taxes are going to hit public school systems, and specifically changes in the 529 savings plan and the cost of programs like free reduced lunch. So I think maybe what the questioner is referring to is that there's now, and I'm forgetting whether this is just in Illinois or nationally, you can do some savings. You can use a 529 savings for K-12 private schools as well as for.
That was the tax
for,
reform.
yeah, that's a national change.
Right.
So how important is that? Do we know?
Yeah, so I'm going to answer because when I was thinking about things I like least about the tax reform, that was definitely one that I considered. The fact that it is national, at least I believe that you can now use contributions to a 529 plan to pay for things like private schools or religious schools for K through 12 education, which in general we like education and that's good spending, but kind of in the same way that I view the mortgage interest deduction, it really seems like a way for higher income people to shield their income from taxes, because those in general people who send their kids to private schools and have extra money to contribute to these accounts. And so I guess I didn't like the distributional aspects or outcomes of that change in the tax policy.
Agreed.
Agreed? No one's going to speak for that change in the tax code, it sounds like. Does the new, I'm hoping I'm getting this right, does the new policy capture the importance of having the economy or other developments? So to what extent, I mean, we talked a little bit about this, about how this might change economic growth, I guess, and economic activity. You know, how much, I guess the question is, how much uncertainty is there about the effect of this tax policy on economic activity and hence on, you know, the ultimate distribution of income and yeah.
Yeah. Well, it comes back to this whole issue about what the responses are, and there's just a great deal of uncertainty about how people are going to respond. My own view is actually there is no uncertainty. I think it's going to be very small, but there are reasonable people who've done very careful studies who come up with different conclusions. So I think those kind of responses will be interesting to see, things in terms of labor supply, in terms of businesses investing more, whether or not that's really going to come to fruition.
So what are the markers we should be looking at over the next couple of years to see what's more likely?
The participation in the labor force, you may know that the number of people who are actually working and trying to get a job has actually fallen quite a bit. And indeed, the reason the unemployment rate is so low is so many people have dropped out of the labor force. So I think one metric would be basically, are those 55-year-old guys going to come back in and start working again? Because now they find it more advantageous. So that would be one number. I would not look at the unemployment rate. The participation rate would be very important. And for businesses, are they investing more than they would have done otherwise? That conditional statement is kind of tricky because what they would have done otherwise is we'll never know. But that's what keeps us busy in the research community, is to try to figure out exactly that counterfactual. But I think investment spending by businesses would be a big plus. Though I must say it comes back to another issue with respect to jobs, because if businesses go out and start investing more and they get very good equipment, those sorts of equipment, software packages and so on may displace workers and may sort of kind of run counter to some of the other goals. I mentioned before, I was only focusing on the size of the economic pie. The number of jobs could be another goal, and this policy may cut against that to some extent.
Erik?
So I just wanted to add a little bit in that, so I agree in that the uncertainty, it's tough to know. My overall guess would be relatively modest. I was somewhat surprised that there aren't more changes in the tax code related to inducing people into the labor force a little bit more, because this seems to be like a Republican theme that they like to do. Like, I mean, there was expansions to the earned income tax credit before. I was a little surprised maybe they didn't want to push that. And even though they reduced income tax rates, which in general you might encourage people, I think would encourage people to work a little bit more, the average tax rate isn't really changing too much, so it might not push too many extra households into working. And so they could have done something like add in a larger child care tax credit or do more. I think they did a little bit there, but I was a little bit surprised that they didn't push more people into the labor force. And since there weren't those changes, I don't expect there to be big changes in labor force participation.
I would add one other thing, and it doesn't have anything to do with the tax reform. It has to do with the expenditure side, and that is the expenditure side going to address what I think Bob was alluding to as and you were pointing to as possible increasing inequities and disparities between the high and the low income, the 1% and the rest. And if the expenditures side doesn't address the job skill level and in providing human resources to, or human services to those that are underserved, then not the tax reform, but the whole product will be a disaster, I think, regardless of what capital formation is.
And I would see a real uptick in the scholarship in the future, all focusing on the ramifications of the tax cuts.
Okay, we just have time for probably a couple more questions. So,
Susan saying more.
what's that?
One more.
One more question. For one more question, we have time for, I guess. So I will. So this is a little bit a change of direction, but we got a question about what are your thoughts on Illinois switching to a progressive consumption tax, and would it be better than a flat tax? Or I guess I'd like to open it up a little bit more broadly. If we think of, in big terms about consumption tax policy, a lot of economists favor that. Is that something that we really should be talking about as opposed to an income tax? And what big changes should we be making?
A soda tax was a great idea, but not for a revenue source. It was a public health question. The difficulty with having some kind of a value-added tax within the state of Illinois is that we're surrounded by other states, and we'll, so long as the neighboring, you can do this in Hawaii because there are other neighboring states, but you can't do that kind of a massive experiment within the 48 states. But what can the state do? A progressive income tax is a fairer tax to reduce disparities. That has to mean a change in the Constitution. To do that, we've got to call for a constitutional convention. We've already turned that down just a few years ago. Every 20 years, the Constitution requires us to vote. So vote and make sure we have a change in the Constitution.
Other people want to talk about big changes, either at the federal, okay, now's your chance to think big sky. What should the tax system look like in the United States?
I mean, we all favor, academic economists all favor consumption taxes for a variety of reasons. One of the big problems, though, is if you change things like that, like if you change this mortgage deduction thing, you're going to have big changes in wealth. So people's values of their homes will change dramatically. Values of their stock portfolios may change dramatically. And while that tends to favor people with higher incomes, a lot of the retirement savings we were talking about that people are undertaking do have assets, stock assets there as well. So I guess I'm saying it's really difficult. While we all favor consumption taxation to minimize distortions, something I obviously favor, there's these big wealth redistributions that are very problematic. In some ways, we're just kind of stuck with it, perhaps more than we like to realize.
Yeah, I mean, I would agree, although I would I like the idea of having more. I mean, if state competition is what we're worried about in having an Illinois value-added tax, I mean, there are definitely lots of properties of consumption or value-added tax at a national level in terms of replacing some revenue from income taxes, lower those rates and have it on consumption. There's lots of reasons to like that. It's tough to know feasibility. It'd be great if states could do it first and we could see how it goes, but the competition aspect's a little tough there. But especially if we need to raise new revenue in the future, I think it'd be really interesting to see how that goes.
Well, I guess I would say something that hasn't been brought up, which is a carbon tax is something that most economists think would have kind of a double winner. It would raise more revenue and also probably deal with environmental problems. And so, it would be nice if the next tax discussion at least had some brought that into the discussion from my perspective. So I think we're out of time, so thank you.
Okay, well, thank you very much, Professor Merriman, for moderating this wonderful panel. And let me thank Professor Hembre and Kennedy and Chirinko and Dean Pagano for participating. This was really fascinating, and thank you. This is quite a distinguished panel. So let's give them one more round of applause. I have small gifts for them as well.